Hello, and thank you for joining this episode of Global Perspectives, a Janus Henderson podcast created to share insights from our investment professionals and the implications they have for investors. I'm your host for the day, Laura Castleton, and for over a year, you've heard us discussing how the relative spreads across fixed income sectors have been creating different risk-adjusted opportunities for investors. Today, I want to take a different format because I'm joined by Lloyd, portfolio manager and head of multi-sector credit strategy at Janus Henderson, and somebody who has been meeting with clients regularly discussing this topic. So today we're going to go through the top 5 questions on fixed income sectors that have come up in our client conversations. John's being more specific to his role as multi-sector credit strategy lead, and my team's as on how to balance fixed income sector exposures in an allocation. John, thanks for chipping in with these questions and for being here today.
Thanks for having me.
Let's start then with just markets in general moving at such a fast pace. In particular, in the credit market, spreads have widened out a little bit at the start of 2025. They're still tight relative to historical standards. So in talking with you, the number one question I think we get from clients is, do you expect this tight credit spread environment to continue, and for how long?
Yeah, it's a good question. Going into the year, our theme was to maximize spread per unit of volatility. We actually didn't think there was a lot of tightening in the spread market, in any of the spread markets, securitized or corporate spreads. Corporates were obviously tighter than securitized going in, so we favored securitized credit. And I think what we're seeing is we're starting to see some widening in the credit markets overall. What's causing that? A lot of it's fiscal policy and uncertainty around the fiscal situation. And so you're starting to see some of the, soft economic data come in a little bit softer, and the credit markets worry a little bit more about that, and we've seen the rate market rally as a result.
So do you worry then, as we look forward to the end of the year? Obviously, we're at a very uncertain time right now. We're recording this pre-April 2nd, which is obviously a big day for fiscal policy and tariff announcements, but regardless, there's still some uncertainty around that. So do you expect credit spreads to continue that widening path, or are there technicals that will maintain the tightening of that market in the IG and high yield space?
Yeah, the technicals are still pretty strong, especially on the corporate side. So, I think that will be an offset to some of the potential spread widening. But, I think with the uncertainty around the fiscal policy, we'll see what tariffs get announced. And then we also have to wait and see what are the counter announcements from other countries as they kind of retaliate towards the U.S. as well. So my viewpoint is volatility is probably here to stay for a while, and we're going to have to let the tariffs and some of the fiscal decisions work their way through to see what happens to the economic data. And if we continue to see weakening economic data, I would expect to see continued spread widening and spread volatility. The other thing we haven't talked about is the Fed. It puts the Fed in a little bit of a pickle. Now, I think they'll focus a little bit more on their employment mandate, but with tariffs, they're going to be somewhat inflationary. And so you could be in this, call it short-term period of stagflation where the PCE numbers are coming in hotter than the Fed wants, and economic growth data is coming in more slowly, right? So is that Fed put going to be immediate? And we're starting to see some of that in the rate market as rates have rallied, and they're pricing in more cuts this year than the beginning of the year.
Okay, so credit spreads still tight, which does leave open the door, it sounds like, for that widening throughout the year. Meanwhile, securitized sectors have, for a while, had much wider spreads than their historical averages. So the second question that you often get is, why are securitized spreads trading wider, and is that something that you see changing in the near future?
Yeah, I mean, I'll start by saying securitized spreads will be correlated with general risk markets, but they started at a wider level, which is one of the reasons we preferred securitized spreads. A lot of that was just technicals or idiosyncratic reasons within some of the markets. And so you've seen a lot of issuance in the securitized market. We've seen the opposite on the corporate side. We've seen the high yield market kind of shrink over the last 3 years. Issuance has been pretty anemic, and that's been a really strong technical in the high yield market. And so I think that's, if you want a starting point for why spreads were a little bit wider. Two other reasons, and I've talked about this before, but on the agency mortgage side, we had the largest buyer, the Fed, move out of the market and go from QE to QT. We saw some bank failures and banks selling their mortgage books, and mortgages generally don't like rate volatility either. So, on the securitized side, mortgages have been wider. And then I think there's also been a little bit more of a general worry about the consumer in the U.S. and how strong the consumer would remain, which fuels a lot of the securitized markets, especially in the ABS market. So we've had a differentiated view there where the consumer's been pretty strong. And so we've been, kind of very constructive on the ABS market over the last couple of years. So the nice part is ABS and CMBS and agency mortgage spreads are starting from wider levels. So I think you'll see less widening. And we've actually seen that in this initial backup. We've seen high yield spreads sell off, call it 90 basis points, and securitized spreads have done a lot better than that.
Even securitized spreads are correlated to risk markets. And if we do start to see, as you mentioned, softer economic data coming in, you would likely think they might widen out as well, but you just maybe answered that. They already started a little wider, so they're a bit more insulated.
Yeah, we've seen them outperform kind of the high yield market and IG markets at this point. And I would expect that to continue going forward if we see more volatility. And mortgages have outperformed as well. The nice thing about mortgages is there's no real credit risk there, right? So they almost provide a counterbalance when they were starting at the wider end to some, IG corporate spreads.
Yeah. Okay, great. So that's something that we've talked about regularly, again, with clients for over the past year, just this dynamic of securitized, maybe offering some better risk-adjusted yield and spread than credit markets. That will not always be the case. So the third question that we often get is, how have your strategies been positioned? I think we kind of know, but maybe reiterating that. And then what in your outlook would cause that to shift going forward?
Yeah, I think it's just the relative value shifting between corporates and securitized. We started the year off with corporate spreads at almost, all-time tights, first percentile. They backed up. They're in the, call it the 20th percentile now. And as we see those spreads back up more than securitized, it just becomes a little more attractive as those spreads back up, and back up more than the securitized side. And
this is something that's happening quickly, right?
Yes.
You're monitoring almost on a daily basis.
Correct.
Yeah.
Correct. You take advantage of what the market gives you when you're seeing these types of moves. So, the volatility, I think the volatility gives, funds tremendous opportunity to asset allocate and move those allocations around as you start seeing value in different markets.
Which is extremely attractive for the clients that I'm working with. So if we transition to, in our consultations, probably the fourth and fifth question get down to implementation of these ideas. So it can be very attractive to investors and clients that we're talking to about securitized spreads over corporate, but the implementation is hard for them to do as quickly as you're able to. So the fourth question that we typically get is just generally the role of a core plus in a portfolio, particularly for clients who have shied away from duration for a while. So from my perspective, when we talk to clients, one, I think it's hard to move away from money markets. I understand that, but it is clearly starting to happen. Clients are starting to invest heavier in duration. Our average client that we work with, their portfolio has a duration of about 4.2 years. So it's starting to happen. We've seen that trickle up a little bit. From my perspective, in a portfolio angle, Core Plus can provide that professional sector management to the higher credit quality universe of credit, sovereign, and securitized through agency. But it also can provide that ballast of equity volatility, which we saw at the beginning of the year. When you have more duration in higher credit quality fixed income sectors, you can have the greater potential for total return. So that's what we see as the role of Core Plus. Would you add anything to that? And then how does Janus Henderson approach the Core Plus universe?
Yeah, I think from a broader portfolio construction viewpoint, the nice thing about Core Plus, and we were talking about this going into the year, is we expected sometime this year, I'll actually be honest, I thought it would be more second half than first half, is that we would see negative correlations between rates and risk markets again. And I think we've seen that with some of the fiscal policy uncertainty that we're seeing today and the equity sell-off. So That's a real advantage. It's going to carry 6+ years of duration, generally speaking, and be in high quality credit to get some added carry while you own that duration. And so those are the advantages today. Is you're not looking at a 22 period where the Fed's going to be hiking and you got to get out of the way of duration. Now is a time where duration can actually be pretty beneficial in portfolio construction, more broadly speaking.
And the reason that we as active managers can add value to our end clients is because, again, that duration isn't created all equal, right? You do want that balance of where the risk-adjusted spreads are today, and that's what we can do in the space is be extremely flexible.
Correct. And we still have an asset allocation process where we can be overweight securitized or agency mortgages versus corporate credit, and where are we getting the best spread from what sectors as well.
Yep. Okay, and then that gets us to the final question that we get. If I start from my side, the question is generally, what can a multi-sector strategy offer above a core plus strategy in a portfolio? And my answer to that is, core plus is constrained to the amount of allocation it can go to the more nuanced below investment grade sectors. So one, you're opening yourself up to a greater opportunity set to more high yield or more of these agency CMBS type or below investment grade securitized sectors. So much wider opportunity set to begin with. But then there's also that potential for, in that area of the portfolio, more yield generation with less duration sensitivity, all the while not having as much of a high correlation to equities that you would get from only allocating to something like a high yield, a preferred or a convert type strategy. So it's that flexibility for more yield generation and a greater, wider opportunity set of sectors. Would you agree? Anything to add on that? And then maybe, again, how does Janus Henderson approach the multi-sector credit space?
No, I think that's a perfect description of where multi-sector fits. I'm talking to clients, I think it's better than any single asset fund because you're getting a free diversification benefit across all the asset classes and a fair amount of alpha by asset allocating to sectors over time that are cheap, right? And then the other area I think we see clients taking some of the core plus and moving that out to get a little bit more yield as well, while still keeping some core plus because it's going to be obviously much less equity sensitive. And then I think to go to the second question that you asked is, how are we differentiated? I really think at Janus Henderson, one, we think of it as a best ideas strategy across all the sectors. And so, in each sector, we're gonna basically run our analysts' top ideas, and that's one of the biggest drivers of alpha. And then the other one we talked about, which is asset allocation. And, on a monthly basis, we're looking at how what's our asset allocation mix, what sectors are we overweight and why, and how do we generate alpha from that as well.
Yeah, and that's the key with our clients that we're working with and discussing the flexibility of sectors is there obviously a wide opportunity set of places to go in the intermediate core plus or the multi-sector category in general. And they're entrusting you and others to make these decisions so that expertise, not only just in understanding the sovereign treasury market or the credit market, but understanding that third securitized bucket goes very far in both of those categories for that dynamic flexibility.
Yeah, and one thing that's nice, in the category, there is wide latitude for the manager. Seth, John, and I basically designed the strategy 11 years ago. It's the same PMs on the strategy over 11 years, and we have an 11-year track record of how we manage through every cycle. So you can see we're pretty consistent through the cycle of how we manage. We're not taking huge duration bets, one-off duration bets here or there, or massive sector bets. It's a pretty consistent process that has an 11-year track record in the category.
Awesome. Well, thank you for being here today. There's a very clear dynamic of where spreads are in the market, where they've been over the past 5 years, but things are changing very quickly. I think it's great that investors can have an opportunity to go with someone like us or someone in these spaces to manage these sector changes for them on the fly. And thank you all for listening. We hope you found the conversation useful. For other insights from Janus Henderson, you can download other episodes of Global Perspectives wherever you get your podcasts or visit janushenderson.com. I've been your host for the day, Laura Castleton. Thanks. See you next time.